Okay, it's 1 o'clock and time for the Wall Street Crossover Show, starring Darren Sinden, who is the market commentator at Admiral Markets, who sponsor this particular show. Good afternoon, Darren.
Afternoon, Zach.
Right, nothing happened.
No, we never expected it to, of course. And I think the main takeaway was, that they are considering external factors a bit more than people might previously given them credit for, because they've got a complicated mandate, the Fed, and we don't think they're going to do anything because they don't want to make a false move. They seem to be implying that the US data probably could warrant a rate rise. That's not entirely our view, to be honest, but as I say, they're placing this emphasis on external events, namely the global economy in China, and preferring to hold fire, and we'll see a presentation at what the chances are of October or December.
But whatever excuse not to raise rates, whether it's something external, internal, somewhere in the middle, Janet Yellen feeling a bit ill that day, whatever, but just we're not raising rates.
No, absolutely not. And there is a school of thought that suggests that the longer that they defer, the narrower the window of opportunity is, and that they might miss the boat completely. But that's probably a conversation for another day.
Okay, well, let's go straight into the slides. The data released over the European session.
Okay, well, to be fair, there was no real European data today, so we just look at a few key bullet points from the US and Asian sessions. Federal Reserve, we just discussed, no change due to global volatility, and the statement had what one would term a dovish tone. Then China, surprising actually perhaps this, but China house prices have rallied for a fourth straight month. Nothing fantastic, but they measure the prices of houses in 70 cities tick up with this number, and the rise for August of plus 0.1% on top of a similar rise for July and June. In fact, we've had small positive gains ever since May now. So some small crumb of comfort in China property, but obviously they've fallen from a very high level, those prices, so it's not surprising they should be bottoming out at some stage. And then staying in Asia, we had the release of the Bank of Japan minutes. You know my views as a skeptic of Japanese economic and monetary policy, and pretty bearish on the outcomes. The Monetary Policy Committee members in Japan are hoping for a global and emerging market recovery to come to their rescue, which...
good luck with that.
Well, those are my sentiments exactly. Somewhat deluding themselves, I believe, if they think that that's likely to happen. There was obviously more comment in that report, but that's the takeaway that I took out from that. As we said, no significant data in Europe. There was some balance of payments data, but that's neither here nor there really. So.
Okay, well, let's go on to the European movers. Okay,
well, we're staying in a sort of mid-cap space again today. First of all, in Germany, Hella KGA, the automotive electrical component manufacturer, that's HLE, the ticker in Germany, €33.92, down around 9.17%. They have issued a profits warning. This was perhaps more of a localised one-off issue than anything more major, but they've issued this profits warning because one of their major suppliers in China has failed. As I say, it seems to be fairly localised and one-off, but it's the second German mid-cap that's warmed in a week. Could be
sort of going with the flow of sentiment.
Yeah, absolutely. So keep your eye on that, and they're down just over 9% on the day in Germany. And then moving across the border into France, Ingenico ING in Paris, €105.60, up around 7.34%. They're better on a relief rally after their rival WorldPay has decided to opt for a stock market float rather than a trade sale. If they had gone down that trade sale route, then Ingenico had been thought likely to bid. So
never too late, I would say.
Oh,
in
no,
current stock market conditions.
That's true, but for the moment at least, they're bouncing, perhaps on some short covering if nothing else.
Okay, let's go for the M&A rumours and movers.
Okay, well, I just thought we'd review the big deal that was announced earlier this week. In the absence of a better story, Anheuser-Busch, which of course is ticker BUD, has approached its biggest rival SAB Miller about a merger between the two brewing giants. But it really is, would be a merger of giants. There's another way to put it. SAB shares have underperformed global peers as their beer volumes have slipped. But if we just try and take a brief look at what the merged group would entail, would be genuinely a mega brewer, would have a market cap of $69 billion. It would have 50% or capture 50% of global brewing profits, and would have a 30% market share in beer sales. The chart here from The Economist just gives you an idea of where the companies are placed relatively. AB InBev at the top, SAB, Miller, there. Sorry, AB InBev, of course, being Anheuser-Busch, SAB, Miller second, Heineken fourth, and Carlsberg. Heineken third, sorry, and Carlsberg fourth, but then some Chinese and smaller US brewers. But basically, you get the picture. If these two merge, if they're allowed to, because it's be a massive competition issue, then they would massively dwarf.
Yes, I don't think the competition would be very pleased. I also think that maybe the $69 billion figure you got there is a bit small. I think that might be just the size of one of them, but anyway, we can look that up at a later point for those who are keen. But $69 billion isn't that much. I would have thought it might be a bit bigger than that. But anyway, it would be a massive new company.
Yeah, and I think the thing is, if it were to go ahead, then you'd surely have to think that those further down the league table would rapidly try and consolidate with their rivals. It's interesting as well that there are a couple of Chinese names on that list. They haven't particularly tried to expand outside of their local markets, and so I wonder what part to play they would have, if any, in a further round of consolidation. Anyway, all over to the competition authorities, but this one's going to run and run. I'll double check my figures and let everybody know on Monday.
Okay, well, let's go for the US data points.
Okay, well, after all the excitement of yesterday, there's not too much to look forward to. Having said that, it is the September expiry, so many monthly and quarterly futures and options will expire in New York this afternoon. So
there's quadruple witching,
yes,
all sorts of horrific sounding things going on.
Yeah, that's what's happening today. Although I think probably any market moves were going to happen yesterday rather than today. But nonetheless, the open could be interesting just because of the.
Well, I sort of had the feeling that they were holding the market, or the market was being held up ahead of the FOMC, and presumably also ahead of the expiry. Yes. So the floodgates might be open.
Well, possibly.
There's, either up or down, but the floodgates, there could be a change after that.
There could indeed.
Next week or later on. It'll be
interesting to see how the markets close tonight. And then the one data point we have got is one that probably should get a lot more coverage than it does. Leading indicators for August. This is a composite of 10 indicators that supposedly lead economic activity in the US, but it's not one that people really look at enough. The forecast is for a small gain of plus 0.2% for the overall indicator, the composite indicator, and that's compared to the previous month's minus 0.2%. If you look at the history of this leading indicators figure, it actually hasn't shown that much growth in the last 2 years, and perhaps that's why people don't give it so much credence, because it's actually been relatively inactive in terms of predicting the US economic growth.
which is an indicator of its own right.
Well, it probably is. In fact, perhaps that's exactly the way to read it. But anyway, that's coming out later today, so I'm sure, given yesterday's comments from the Fed, people will perhaps pay a bit more attention to that today.
Let's go for the US pre-market movers, if we can.
Okay, so we start with AK Steel, ticker AKUS. AKS rather, US, $3.18, up 13.17%. Good gains here for the troubled steelmaker as it offers a brighter outlook for the coming quarter, and it suggested that losses at the business would fall sharply. So they're thinking of a range of around between 2 and 7 cents for the coming quarter, as opposed to a loss of 36 cents per share last time round. So that's good news. But obviously, for those that don't know the stock, it's fallen very hard for the last couple of years, so something of a revival perhaps on the cards there. And then Adobe Systems, ticker ADBE, a company that most people would be familiar with through their PDF viewer software and Photoshop, another one of their brands, but they're trading at 78.60, pre-market down around 2.13%, and the company announced management changes and lighter guidance last night, so a bit of a disappointment as far as the market's concerned, and they could perhaps move lower again if the market were to weaken in proper trade this afternoon. And then as to levels to watch today, we'll start with European cash equities and the FTSE. 6100 I penciled in now as our key support level, plays 6190 on the upside, but the bias is very much to the downside today. And in fact, the DAX has broken below the 10,000 handle, as we suggested was possible earlier in the week. So 99.40 now, our support level, plays 10,130. The level.
It'll be interesting to see whether that actually brings in buyers or not, but obviously it's a crucial level now.
Yes, it's psychological if nothing else, isn't it? And then in the S&P, 1980 now on the downside, plays 2,000, so gradually trying to claw back the losses that we saw in August, as is the Dow, but that stays at 16,635, plays 16,760. Again, will be very interesting to see how that index closes on the week. Currency-wise, after the news from the Fed last night, the dollar weakened. We can see that most obviously in euro-US dollar, which is now trading around 114.15, or at least that's the level to beat on the downside. Plays 114.85 to the upside. The Aussie dollar has strengthened again. 72.00 now is our downside level to watch, playing 72.65 to the upside. Dollar yen has slipped back. The yen strengthening against the dollar last night and breaking below that 120 handle cleanly. So 118.90 now on the downside, plays 119.40 on the upside. And cable, we wondered if it would rally on a rate rise. It's done the opposite and rallied on a no change. 156.04 on the downside now, plays 156.64 to the upside.
Do you think with the currencies that people have actually got fed up now, waiting for the dollar, waiting for a rate rise and the dollar to rise, they're actually sort of saying, well, actually, we're just going to start selling the dollar?
I think there's probably an element of that, and there's probably some additional book squaring after the, if you were positioned for a rate rise and you didn't get the result you wanted, then there's probably no.
It's taken a year. It's been a year of like dollar strength, and it's like they're not doing anything. So what's the point?
No, that's very true. I'm just thinking more of short-term traders. If they were long ahead of the announcement, they would have unwound by now, I'm sure. Yeah.
Okay. In focus. Speaking of interest rates.
Okay. Well, it's obviously not going to go away, this story. As we know, the FOMC chose not to raise rates last night. And the question now is, will they rise at all in 2015? They expressed, the FOMC expressed concerns about the global economy in China, despite what it saw, as I already said, a domestic stable outlook. Fed funds effectively tracks US interest rate policy, and it can be used to interpret the odds of a future rate rise. We can just see how it's traded, but there's the clear spike as people reacted to the idea that we weren't changing now, we might not change later in the year either. So the likelihood of an October move, or the odds of that, have reduced to 25% from an expectation of 37% pre-announcement and a read of 50% in August. And if we look further forward into December, then the market's telling us that the chance of a rate rise in December fall to 54% from a reading of 62% prior to the meeting, and as high as 73% from a month ago. That data all comes from the CME, Chicago Mercantile Exchange. It's very interesting to see now how the hopes of a rate rise in 2015 even, are ebbing away. That's not to say that they couldn't bounce back from that, but for the moment, I think the way that chart's moved and the way that those numbers have moved is telling us that people are becoming despondent, and they've got less belief in the idea that rates are going to go up this year.
But at least from a strategic point of view, the Fed coming up with a rise in December is probably the least messy thing to do. The market tend to be more stable at that time of the year, rather than pressing the button in September, October, which was almost certainly going to lead to mayhem. Yeah,
that's very true, and it may be that they prefer to do that, or at an absolute push, go early in the new year. Right. But we'll have to wait and see what happens there.
Darren Sinden, market commentator, Admiral Markets, thanks for your input today. We'll be back on Monday at 1 p.m. with the Wall Street Crossover Show.